Like to start off the show with a kind of a rundown of what we saw happen this week in the stock market, and boy, every week we've been talking about this. There's been plenty to talk
Mhm.
about. I mean, it's it's pretty amazing. There's a lot going on, and a lot of things that are happening. So I'll start with the typical chart here. You can see this again going back to 2018. At the end of 2018, that first dip there that's right over the talk money with Tom sign was the last time we did some tariffs. So I try to keep that in there so people can see. Um, you can see here just recently the market's down this week, right? And there's several different reasons. So this is kind of march through the week and talk about what happened here. So first of all, after hours on Friday, Moody's, which is one of the rating companies, decreased the U.S. debt from its highest level rating to the next highest level rating. And so, the market was responding negatively to that in the morning on Monday, but it actually ended up in the end. And part of the reason is because there's three rating companies: Fitch, S&P 500, and Moody's. And Fitch and S&P 500 already lowered the rating
Yeah,
some time ago.
it's been a long time for those two, I think.
Yeah, I think the first one was 2011. The market dropped like 6, 7%, someplace in that range when that happened. But in the end, it doesn't really mean much. It does mean something in the theoretically that you would pay a higher interest rate, because you don't have as a high a rating, as far as that goes. But the market forces have more to do with what interest rate you're going to pay overall, in my opinion, than the ratings do as far as that goes. So I think it was kind of a non-event, although it turned into be something that added to what happened this week. So, because we're going along, and all of a sudden on Wednesday, the market's falling really hard. It was down 1.6%. And what had happened was that there was a 20-year Treasury bond auction. Okay. And so, just so you know, a Treasury bond is an obligation for the U.S. government, and it's essentially a way for the government to borrow money.
Hmm.
Right. So you put out a bond, okay, we're going to pay you a certain amount of interest for a certain period of time, in this case, 20 years. And they all go out to auction. And so is the auction, well received or not? And if it's not, they generally have to raise the interest rate that they're willing to pay. Essentially, this is a market force that does this. And so it was perceived as a pretty soft auction. Um, it does happen, even, because you could make some arguments for why it's happening now. And we'll talk about that, but it has happened before. I do pay very close attention to the Treasury bond auctions and what's happening there. I think it's one of the most important components of the financial system. We have a country in this particular case that's running a deficit. So that means that, we have less money coming in terms of revenue than we have going out in terms of expenses. And we fill that gap by selling these treasury bonds. And you also have to up those treasury bonds so as they come due. And so that's a big issue that's happening right now. About a third of the treasury debt is coming due the first half of this year.
Yeah,
Uh,
and each year the interest cost is just getting higher and higher and taking up more and more of the budget.
yes, and that's one of because even if the interest rate stayed the same, which they're going to go up here, especially on that third of the debt that's coming due now. But even if it stays the same, if you continuously add more debt, you're going to continuously have more cost. And yeah, it's sort of a spiraling piece of the deficit. I forgot the percentage of the total, that of all of our, expenses, how much goes to interest on treasury debt. You can look it up. My gut feel was some in the 7, 8% range, but it could be higher than that. So that was happening on Wednesday, and the market's dropping. Also on Wednesday, that didn't really help the bond market, especially, and ultimately the stock market, was the fact that they're working on this tax relief bill, and the point that they were working on at that point in time is what called the SALT, which is the SALT is basically your state and local tax, I think, something like that. Is that what it stands for?
Hmm.
And what that is that we could always write off all of that. So you could write off your property taxes, you could write off your state taxes, and then in 2017 they capped that at $10,000, and so now they want to move that up, and so they did decide on Wednesday, or at least so far, 40,000 was going to be the new cap. And if you made 500,000 or more, that cap would start to diminish. You would not be able to take as much write off. And so, but it added a lot, 900 billion, I believe, to the overall cut in
Hmm.
taxes. So that means you got to find that, the savings on the other side. So, but at the time, they just added to the deficit
Mhm.
basically. So the Congressional Budget Office, the CBO, had the deficit for a 10-year period with the bill in that manner set at 3.8 trillion. And so the bond market's starting to kind of freak out because that's where that money's coming from. If there's 3.8 trillion on there, that money's going to come in the sense of the U.S. selling these treasuries to try to, sponsor that. And look, everybody knows this, especially the bond market. What they're saying is a projection is almost always lower than what it actually ends up being. Because I remember in 2017, that was supposed to be more or less a revenue neutral situation. It wasn't. And again, both parties are guilty of this. You have to use this reconciliation process to get it through the Senate with just 50 votes
Mhm.
instead of 60 votes. And so you take a 10-year look and you match up the expenses, that you're going to have, or the revenue you're going to lose in essence, and then where you're going to save that money. And theoretically, those are supposed to get pretty close together in order to get through this reconciliation process. Um, and so, uh, that's happening. And if we look here, you can kind of see here's a more year to date daily look, and you can see where the market is kind of keeling over there,
Yeah.
right? And so we had this nice run that was going from the China resolution, getting it down to 30%, and now it's more focus on this tax bill. Well, Wednesday night after the markets closed and Thursday morning, they actually changed the tax bill to increase the savings. Okay. And they brought the projected deficit down from 3.8 trillion to 2.3 trillion. Okay. Now, the way that they did that is that they they had the Medicaid cuts starting when Trump left office,
Mhm.
basically, so that the pain can happen after. So, got 4 years of that 10-year period, no Medicaid cuts, and then Medicaid cuts start after that. Okay, so the what they ended up negotiating is that the Medicaid cuts will start sooner. Okay, and I've had some clients say, "Well, why is that good?" It depends on your perspective. Unfortunately for me, I'm an advisor to a wide spectrum politically of clients. I've got clients who think that it's awful that people are losing their Medicaid, and I got clients that think it's a pretty good thing. So I'm not making political or social commentary. I'm talking about what the market's looking at, and what the market wants to see is less deficit. Okay, because we're already at a pretty high deficit. Adding more to it is scaring the bond market. And so, nonetheless, what happened was that they ended up uh, making it so it will start instead of 2029. It'll start by the end of 2026.
Mhm.
So that's very interesting. Think about that. What happens in 2026?
So basically, after midterms.
Yep. So they're going to have the Medicaid start. I will say that it's not popular, definitely on a poll basis, and so they're trying to keep away some of that pain from their midterm chances. But nonetheless, when we look at the actual bill itself, the market did, seem to like it more. Today, what's happening is we're reinvigorating the tariff war. Two things. Number one, 25% tariff on Apple products if they don't make them here, because they were moving production for U.S. products from China to India, and Trump doesn't want that to happen. Uh, I don't see a way that even 25% is going to sway Apple to move here just because the cost would be pretty prohibitive. But I think one of the problems with all of this has to do with the timing, right? So, how fast are they supposed to be able to do this? I mean, are
Mhm.
they putting a 25% tariff now? Because we're years away from being able to build an iPhone here in the US, even if we wanted to, just
Yeah.
because, I mean, all the parts are made in other countries and what have you. So, it's going to be an interesting battle there. We'll see how that plays out. But then also, they paused the tariffs, right? The big tariffs from Liberation Day, and they've been negotiating. And Trump is frustrated with the negotiations that are going on with Europe, and so he's now threatened a 50% tariff on Europe starting June 1st, which is pretty soon.
Still a
Uh, uh,
weekish away.
yeah, so the market's down. Is it back up? It was coming back. It was down like 1% and it's starting to come back up. I think one of the things the market's starting to realize is that this stuff, if it really matters, like it did with China, they back down. And so, if it's just talk, I think you're going to see the market ignore more and more and try to focus on, like what really matters, what's really happening as far as that goes. I'd say the budget deficit is more of an important component than what they're arguing about with tariffs. Is it back or no?
It's dropped around to around 0.6 now.
Point two. Okay, so it was almost back to even before the show started, and it's coming back down again. Probably people taking some risk off the table before the holiday too. So, uh, so let's look at some of these things. So first of all, here's something important. The market got back up almost to 6,000 points, and I was talking about this week. There's a pretty good chance that it bounces down off of that. So if we ignored all the news and didn't even know what was happening, and I looked at that chart, I'd say, yeah, that makes complete sense to me.
Mhm.
There's a lot of overhead resistance. You can see where the market spent a fair amount of time right above that period. So a lot of shares are accumulated there. And again, the idea behind support and resistance is that now that I got back, let's say I bought at 6,000 and I'm down, got down to 5,400 or whatever, and it gets back to 6,000, I'm pretty happy. I might take my money back, right?
Yeah.
That's the idea behind that. And so then it takes time. You kind of have to bounce against that to absorb all those, institutions or people or shares that are out there that are going to be for sale at that price, right? As people try to get their money back. And then maybe if you're still going upwards, you'll crack through that. Right.
Mhm.
Now, what if you're still going downward? Well, there's a couple of things that I watch for. Number one is, do we get, back below this high? Because that was kind of a big deal. We started to reestablish, a primary trend to the upside here, at least temporarily. And so does it hold that? Yes or no? We'll see. We're really close to it. So maybe not. And then, maybe most importantly, in terms of trend watching, is just, do we set a new lower low? So there's one, right? Do we go below that point? And then we're back into, hey, primary direction is still down. And you could basically go back to the beginning here and say, hey, this is just a false move. We got a lot of these false moves in 2022, big ones. This is almost 20%, I believe, recovery. We had an 18% one in 2022 that ended, I think, August 16th, as I recall. And so, these things happen as far as that goes. Let's look at a couple things here that I think are interesting. This is an iShares U.S. Treasury Bond ETF. I like this ETF to follow the overall Treasury bond market because it goes from 1 to 30 years. It's weighted roughly like the overall Treasury market. And so this is month to date. Okay. So what you're seeing here is the value of the treasuries are falling, right? And so it's a huge deal. It's a really, really important thing that we be able to continuously sell treasuries, especially in the next big downturn. Because in the next big downturn, we need to be a country that people want to go to for safety. They want to buy our treasury bonds because we're going to have other countries that own our bonds now that might need to sell them because they're having their own situation during this overall meltdown that could be happening. We may want to do stimulus things like we did in 2020 and 2008. And again, we have to be able to sell treasuries to do that. So when you look at this chart, you say, okay, that's not good. We're going the wrong direction. However, I will say a couple things about this I think are very important. Number one is right over my shoulder here is the low point that happened on Wednesday, right?
Mhm.
And then 2 days now since the passing of the bill with the House, the bond market has been going up. Okay. It's been going up. To me, what they're signaling is the $2.3 trillion deficit that's in that tax bill and all the other components of that tax bill are okay with the bond market. That's incredibly important. It's only 2 days. We'll see how that plays out. The bill's not done, but it's not what was happening as they were talking about it before with the higher deficits built into the bill. Okay. Now, here's the second thing. Let's back up a little bit and take a look and say, okay, here's year to date on that same thing. Now look at it, right? So you got to be really careful taking these things out of context because really we were just coming off of a high that's in a range. We had these two peaks, and we're more or less back into the range, right? We're
Mhm.
a little bit on the low side of the range. There's some reason to watch this, but we're not even back to where we were, back at the beginning of the year. So, okay, Treasury bond market isn't as scary as everybody's talking about. I will say it's a little different on the very long end of the bond market, the 30 years above 5%. That's not very common. and that's usually associated with some trouble as far as that goes. So there's some things to watch here, but overall, the bond market isn't that scary looking to me when you look at it, at least, even year to date, which isn't very long term to look. The same thing's happening with the dollar. So here's the dollar year to date, right? This is DXY is the dollar against a basket of currencies,
Mhm.
right? So coming down, yeah, the dollar's coming down. And generally speaking, those go together. If foreign entities, countries are selling our treasury bonds, they're moving out of dollars back into their currency. They're selling dollars also, so should be coming down. We saw some of that in the tariff situation. One of the problems that you have that's kind of interesting is when you cut down on trade is one of the things that brings in money into the dollar, into the treasuries. Because
Mhm.
I'm a Chinese company, I sell something here in the U.S. I get dollars for that. I might, park that in U.S. Treasury. So China, as a whole, is the third largest holder of our debt. Japan, I believe, is number one. Um, and so when you reduce the deficit with these countries, there's less money coming into our treasury market. So now, again, let's back this up a little bit. Here's a 5-year look on the dollar. You know, again, it's below that range right now by a little bit,
Mhm.
right? Something to watch. But it's also coming down off of a pretty big high year to date. That's why that chart looks so weird. So again, sometimes you have to back up and have a little perspective on, where things are as far as that goes. And so, uh, let's talk about what these tariffs mean. We're at I've seen two numbers now, two different studies. One is 14.4% net tariff. The other is 17%. So we're someplace in that range. We were at 25 to 27 was the numbers I was seeing before they reduced the tariff on China from 145 to 30. Um, what's going to happen with that, right? So that's what the Federal Reserve is asking. Does that cause inflation? Where do those costs go? Everybody assumes it's going to make things more expensive. Via the surveys, consumers feel like inflation is going to go up over 6%
Mhm.
in the next 12 months. And so, you know, trying to see where it actually goes. We're still in this zone where we haven't even seen the hiccup that's been caused by the no shipping coming out of China for that period of time. So those would be things that we kind of watch for. But there's enough risk here. What's happened is, we've gone from 2.2% tariffs to 14 to 17% tariffs. And we don't know, uncertainty is very high. Matter of fact, I'd say it's probably the biggest risk to the economy is uncertainty. People that are spending money, consumers, businesses, aren't sure what to do. I mean, across the board with my clients, they're spending less money, all of them. They're not traveling as much, what have you. We're seeing, that uncertainty is related to international travel into our country. A client tell me, he flew to England, full flight, fly there, half a flight on the way back,
Mhm.
right? And he says he's from England. He's been there lots of times. He says never seen that before. So, how does that impact the overall tourism industries? And so, what are these impacts? So, we had 63% in the stock market exposure across all of our clients. We reduced that down to 22%, and we're down back up to 46%, and we still haven't gone all the way back up. And that's because of these uncertainties. And, this week it's probably paid off, right? T-bills. This is what a T-bill looks like, right? T-bills are go up every day, pretty much, right? And certainly this week has been down. I think long term, I think one of the things that's getting ignored here is how much amazing things are happening in the area of technology with artificial intelligence, quantum computing, and all these areas. They're kind of getting buried by these storylines of tariffs and tax cuts and Medicaid cuts and all those types of things. So I think there is some really amazing things percolating along under the surface here that they were getting attention,
Mhm.
right? And we got a big bump out of that in 2023, 2024. And we saw Nvidia doing so well. We saw all these things. And now they're getting kind of buried, but they're still happening. There's still money coming in there. These AI companies aren't even having to go public because there's so much private money coming in, on a funding basis that they are not needing to go public to get money. And so there's some reasons to be in the market, but we still have 13% of our money in T-bills, ultra short-term bonds, money markets, combination of those types of things. And it's just to be a little bit cautious here because this is pretty unprecedented. Yeah, and just kind of what we're dealing with. And so we'll see how that plays out. But pretty fascinating week. I mean, incredible soft treasury thing, a downgrade on the treasuries, the different pieces of the tariff war that's firing back up here on a Friday, and that kind of stuff that's been going on. It's still pretty credible time frame to be looking at the market and trying to figure out what is going on here, and worse, trying to figure out what to do. This is probably the hardest environment I've seen in trying to figure out what to do. In 2008 we did quite well in that time frame, but that was like a normal economic downturn. You could see the dominoes falling, could maybe even predict where some of the other dominoes were going to fall. 2000, that was just a overbought bubble, PE of 45 on the S&P 500 at one point in time. This is a small group of people deciding whether we have tariffs or not. And so, if you looked at tariffs and said, wow, those are high, well, they could change tomorrow. As a matter of fact, they did. Over the weekend, 2 weekends ago, the tariffs on China dropped from 145 to 30. And, whatever our net tariff is, if it starts to bring down the economy, I think they'll lower them, right? And so, however, there's still this risk that they might not be able to control everything that happens. What if Japan falls apart and defaults because they're having some problems right now? What if China, who's already having problems, who's now probably even having more problems, what if they default or have issues? So our stock market's not going to survive those types of things. And so when you put the world economic system, financial system under stress like we're doing now, there's just that risk that's out there. And that's what Jamie Dimon was running around talking about this week. And he's the one that was running around in 2008 talking about very similar things. So, I think a 13% holding outside the market right now kind of keeps our powder dry and gives us a chance if the market does come down to maybe get in at a lower point. But otherwise, it's just kind of protecting the asset base. Yeah. Okay. So that's a summary for this week. Thank you for joining me for that part. Look forward to, again, discussing that again next week.